in the last few weeks, it's been a kind of a tale of two different markets, which it usually is with institutional and retail. But the institutional market, in the volume that we've had, a lot of times you've heard about markets rallying into volume. Well, this has been the case in the last few weeks. You've had $1 billion Hawaii issue, you've had billions of dollars in California, you've got $1.4 billion coming in Texas. And because of the block size that's there, the institutions have managed to glom on to what they can, and it's sort of slaked the thirst that they've had recently. But because of the volume, and because of the length of some of these issues, and the relative spread to treasuries, there's also been a move on the part of some institutions to buy into this marketplace, hoping to flip, or that is, reverse the trades after the sleepy holiday has passed. So that also increased the demand. But where retail is concerned, the spread between, again, treasuries and munis having narrowed to the extent that right now 10-year treasuries, munis rather, are yielding 93% of treasuries, and in 30-year range, munis are at 102% of treasuries. And that's brought retail into feeling, they're starting to feel more comfortable about getting involved in the intermediate range out to about 10 years, 5 to 10 years. And I put together a little example as to why this is. Now, of course, the fear still exists of higher rates, but then that's been there forever. But with QE ending, the fears have been somewhat exacerbated, and retail's been backing off a little bit from the marketplace. However, right now, they've been focusing in that 5 to 10 year range for the following reasons. If we look at a 5-year, but here's the catch. Here's the catch. They're not looking at AAAs and comparing AAA munis to treasuries. Right now, with munis at 93% of treasuries in the 5-year range, you're able to get a taxable equivalent yield of a 229 on an A-rated muni. Now, why would they look at an A-rated muni? Well, the relative risk in municipals over other securities, corporates, for example, is minimal. And so, out to 10 years, groping for yield, retail is willing to look at treasuries. at A-rated paper. In the 10-year range, you've got A-rated munis yielding a 417 taxable equivalent. So it's not difficult to understand why individual investors are getting involved in that range, and they're feeling comfortable. They're not having to stretch. But what is interesting is that finally some retail investors are getting the clue, and they're looking at kicker bonds. And kicker bonds, for example, there has been recently in the marketplace Miami-Dade County Airport 5 3/8 due out in 20 years, 35 in fact, that is 2035, with a call in 2020 at par. Now, a non-callable A-rated straight muni doing 5 years is yielding somewhere around 1.49, 1.5%. To the call, these Miamis are yielding 2.37%. Now, of course, there's the risk that these bonds won't be called and they'll go out to maturity, for example, and that's where the kick comes in. So, on a 30-year, I'm going to call it non-callable, even though the bonds are technically callable. There are bonds that are trading at slight discounts and have been priced at slight discounts out in the long end. And so non-callable paper out there has been yielding somewhere in the neighborhood of 3.6%. The Miami-Dates, if held to maturity, are going to provide a yield of a 4.19%, a taxable equivalent of a 6.4. What are the added advantages to having those bonds? Well, cushion bonds. We've heard that term a lot. In a period of rising interest rates, obviously with a 5.5 or 5 3/8% coupon, you get a cushion against the downside. It's not like those long 3 3/8 that are trading at a 3.50, which are going to probably fall fairly rapidly if we have an ascent in rates. Also, the tax-exempt cash flow for individuals. 5.5%, can't argue much with that, albeit with a $115 price, but what is the opportunity cost? It used to be a lot greater when we had higher rates, not so much right now. Number one, taxable munis are finding their way into sheltered accounts. I talked to a trader the other day in Texas who said that MAC, the municipal authority, which is non-for-profit down in Texas, Muni Advisory Council, has in fact been buying taxable munis. There doesn't seem to be any lack of demand for taxable munis. I was introduced to a new term in the last week, institutional retail, which is kind of interesting. And it came to the fore because, as you'll notice, there are a lot of new issues, sizable new issues, where there is a retail order period in front of the institutional order period, so retail can get its bonds, mom and pop. Well, that's the way it used to be. It used to be mom and pop. Sometimes in the old days, you even had to have the zip code of the people that were buying them to guarantee that this was, they were getting preference. But now, SMAs, bank-affiliated private wealth divisions, and the like are considered eligible for these retail order periods because ultimately the securities are going. And so mom and pop are still kind of at the bottom of the list because some of these people can produce sizable orders. Compliance continues to be a problem, but compliance is becoming more and more and more of a headache for the issuer too. Several years ago, the way they did this was they put pressure on the broker-dealers and said, you can't trade or sell anything where the issuer hasn't agreed to give you regular reporting of their financials. And so the onus was on the broker-dealer, effectively keeping the issuer out of the marketplace if they didn't comply. Last but not least, we have one more comment on that. One more comment. All of this cost of compliance is coming at a time of declining spreads, underwriting spreads. Underwriting spreads are down a full 30% since the mid-90s. So you got all this new compliance, all the expense involved, and thinner spreads. So there's a lot of pressure being put on the broker-dealers.